Hello everyone, welcome to today's topic, how to not fall into an IRS audit trap. What I'm trying to talk to you today about is your chances of winning the IRS lottery. If you like gambling, if you like Vegas, if you like all that fun poker game and chances of winning and trying to play with the odds in your favor, you may be interested in this topic, how to win the IRS lottery pick, which is something you don't want to do. So today I want to just talk to you briefly about some of the more audit-ripe areas that you should probably be aware of unless you really want to win the IRS lottery choice. Now that doesn't mean you shouldn't take advantage of some of these deductions if you have, the key here is substantiation, backup, very good records. The IRS's litmus test for any business deduction, for example, comes from Code Section 162, which says, is the business deduction three things: ordinary, necessary, and reasonable for your business? And does it make sure it does not amount to something that the IRS would consider luxurious or extravagant given the circumstances? And that's just business. Now we also have individuals that can win the audit lottery. So here's a few things. The IRS considers red meat or low-hanging fruit a business deduction for your automobile that is 100% business use. Now, let's face it, unless the automobile is in the business's name with maybe a business logo painted on the car, chances are it's probably, at least to some degree, a little bit personal use. The IRS, especially, by the way, especially if you answer the question on the tax return that says for your automobile, is another vehicle also available for your personal use? If you say to that question, no other automobile is available for personal use, and this automobile is a 100% business, chances are, congratulations, you're going to lose the audit lottery. Another ripe area for audits is business meals, travel, and entertainment. Especially, the IRS warns us, especially if the deduction seems a little high or too high for your particular industry. The IRS knows, and they have formulas that tell them statistically what the average percentage of gross sales in a particular industry that business travel, business meals, or business entertainment should be. And so if you're outside of that statistical norm, chances are you're going to be flagged, and the IRS will look for the absence of very, very strict substantiation rules in this particular area. And they're going to try to recode them as personal, disguised as business meals. So watch out for that. Have good backup and documentation. The next thing that raises your chance of winning the audit lottery pick is if you are trying to write off on your tax return as a business venture what really is a personal hobby. Especially if you also have a high W-2 from a real day job. If you have a high W-2 and a big loss on your business schedule, chances are heightened that they will think that is a hobby loss. Some of the typical industries that you may have hobby losses in would be things like dog breeding, car racing, horse breeding, and horse showing, those kind of things, to name a few. Another hit list area that the IRS likes to zero in on and see if there's any lack of good record keeping is the real estate ventures. The rule with deducting rental real estate business income or loss is that it is limited, if you make too much money, to a certain threshold. If you want to take the full amount of your rental real estate loss on your tax return as a deduction and you make too much money, you have to claim that you are a real estate professional. And a lot of clients do claim that. The IRS loves to audit this area, and they look at two things, or really one test, to see if you're a real estate professional. Do you spend over 50% of your work life in the rental, in a rental, I'm sorry, in a real estate trade or business. And that can mean you work for a real estate company. You don't have to be actually in business for yourself in the business of real estate to meet this rule. You just have to work more than half of your time in a real estate venture. That's one test. The second part of that test is, do you spend 750 hours a year on your own rental real estate trade or business? Those two together are usually a very hard test to meet, unless you're like a real estate agent or something like that. So watch out for that if you're claiming to be a real estate professional on your tax return. The IRS usually is all over that. And finally, two last things. If you are a cash-intensive business like hair salons, car washes, these kind of things, you just automatically opened yourself up to a higher degree of IRS scrutiny. There's just no way around it. All you can do there is make sure you go overboard to keep good records. And the last area of audit intensiveness is if you claim, or fail to claim I should say, that you have an investment in a foreign bank account or foreign authority, or I'm sorry, authority, signatory authority over a foreign bank account. The IRS is beefing up their scrutiny of overseas dealings, and they are asking all of the tax preparers. So I have to ask you, when I prepare your return, do you have any foreign bank accounts? Do you have any authority over any foreign dealings? And if you answer no, if you tell me no and I put no, and they find out yes, the penalties are huge, like over $10,000. So that's not an area to play around in. So just a few scary points for you. Don't mean to bring you down today, but there's your scare tactic for today. Happy Halloween, even though it's January. Have a good day.